everybody, and welcome back to another episode. I'm your host, Brandon Cobb, co-founder of HBG Capital, and today I've got George Roberts III, PhD, on the show. I'm excited to jump in with George. He is the founder of Roberts Capital Enterprises. He sponsors value-add multifamily opportunities for qualified passive investors. In addition, owning over 550 units as an active multifamily investor, he's also an avid passive investor. So his passive investments have included over 600 multifamily units, car washes, early stage companies, as well as triple net real estate. I'm excited to jump into some of this today, as well as his background, which I think is going to surprise you. George, welcome to the show.
Well, thank you, Brandon. It's a pleasure to be here.
Yeah, it's great to have you on. So I was reading your bio over here, and I purposely kind of left some stuff out because I've never had a guest on the show that was a scientist before getting into real estate. Over here, it looks like you've got some award-winning data scientists and bioscientists. You've got nearly 800 citations in the fields of genomics, microbiology, and physiology. So before we kind of jump into the investment stuff, what's your story and background?
Well, I always loved bioscience. It's something I did very well, but was looking for more freedom. I thought that just going to the business world and getting a comp sci degree would make the difference. But not too long after that, my sister came to me with the opportunity to build some houses, start a construction company, and I saw the entrepreneurial world and decided that that was really where it was at. So ever since then, I got bitten by the entrepreneurial bug, decided that I wanted to have my own venture, which turned out to be buying apartments and adding value through renovations, etc.
So, with your job as a scientist, what does a day in the life of look like as a scientist? Because I know you did a lot here. You were doing genomics, microbiology, physiology. Like, what were you doing as a scientist exactly?
Sure. Yeah, really long hours, experiments that take a very long time to complete. It takes a lot of dedication more than anything. A lot of brilliant people in the field, but more than anything, the people that complete their PhD and are able to go on and do postdoctoral research, it's the people who stick to it. And that's true of anything, but perhaps even a little bit more so with science because you have to really give up almost everything, including much of a social life for quite a while.
So, you were doing a lot of research, it sounds like. Were you working for
Exactly.
universities
Laboratory
or were you
research
working
at
for
the bench.
companies? Yeah.
This was all at university level. I wish I could have gone to a company. I was very excited to go out into industry, but for some reason that just never panned out. So I ended up getting one more academic job after another.
Well, so what did that look like? One more academic job or the other? Like, what were you studying as a scientist? I'm interested because I always wondered, like,
Sure,
how do
each lab
scientists
was
make
different.
money? Yeah, because like I
So
know
yeah,
that like when you work for like big pharma, right, and you're in like the lab and you're inventing like new medications, like I can directly kind of tie how the money pours into that specific field. But
sure.
like with the universities and doing that kind of studies, I've always been interested and had a genuine curiosity, like how are scientists making money in that field? Is it grants that the universities get from the government to fund specific studies around? I don't know, interest of like the government or something like that? Like, tell us a little bit
Yeah, I
more.
mean, it was all basic research. The government funds such a wide variety of research. This was all through the National Institutes of Health. And we did all kinds of things. Like in my doctoral studies, my dissertation was focused on how organisms transition from one environment to another. And we were able to use microarrays, which allow us to look at all of the gene's expression at a single time. And that was something that was a bit new at the time. The technology had been only in existence for a few years, and those papers were very well received. So each laboratory that I worked in was very different, different approach, different goals, but all directed towards basic research, not as opposed to getting a medicine out in the next 2 or 3 years, but just understanding biology and how does it all really fit together.
So it was mainly funded by grants from the government then, or was it
Yes.
tuition from the students? Okay, so it was mainly grants from the government.
Yeah.
And
Mhm.
why would the government give the university a grant to like pay the scientists to go and do the research? Are these some like initiatives that the government is interested in funding for a better purpose of like the country?
Well, yeah, absolutely. I mean, this is one of the things that helps to keep our pharmaceutical industry strong. We do have strong research backbone in our universities. So all that money really pours into having some of the finest technology in the world. So we develop the greatest technology in the world. People come from all over the world to study at our universities. And then a lot of them are going to stick around and they're going to help to enrich our culture in industry. So I think that it all does feedback reasonably tightly to the practical, like drugs.
Okay, so it's directly tied to some of like the pharmaceuticals and a
Absolutely,
lot of the stuff
absolutely.
that we see out there.
Pharma, chemical
Okay.
industry, engineering.
And so you had over 800 citations. Tell us more about that.
Sure. Well, think of it like this. How do you know that a website is important? Well, Google will check to see how many links are to that website.
Mhm.
Those backlinks tell you that what's going on that page is worth seeing. A lot of people calling attention to that page. And
Right.
when somebody publishes a paper, you have to talk about the research that went before. So all of those citations, it's kind of like a backlink on the internet.
Okay, so you had 800 citations are kind of like backlinks to the internet. Were these papers that you were writing
Well,
articles? I mean,
exactly. So
what were
all,
they?
all
What
the
were
other
they?
papers in the field are going to reference my work. So they're going to say, well, hey, why do you think that this experiment makes sense? Discuss it in terms of the literature that already exists. And everything that goes into a research article is going to have a citation. So at the end, there might be 30 citations at the end of an article. And some of the work that I did was just very well received, like the microarray studies. Those were
Yeah.
still very new at the time. And then also some of my work that I did in protein-protein interactions. So I was trying to figure out essentially if, our genes, that's our genetic repository, and we have this gene expression that drives what we do. Well, the expression is the proteins, right? And that's really the machinery of the cell. The proteins do the work, and they have to interact in various ways, turning each other on, turning each other off, directing metabolites through one pathway or another. And a lot of the work that I did was focused on figuring out what do these networks look like? How do they actually work?
Wow, that's really fascinating. So fast forward now, you're working as a scientist and you had done a lot of passive investments, car washes, multifamily, early stage companies, triple net real estate. I know you've got a big focus on multifamily going forward, especially in 2024. Walk us through the path to becoming like how did you go about becoming a passive investor? What did the path look like to, because I'm assuming you started out as a passive investor and then moved into an
I
active
should
investor.
have.
Is that fair to say? Is
As a
that
better path to go. Would have been an easier step up, but I had already been a real estate investor for over a decade. And
okay?
so when I got to multifamily, I thought, well, hey, look, I love entrepreneurship, but now to borrow a phrase from data science, I want to essentially be a real estate owner at scale. So with multifamily, it's great. You can buy apartments, tens, 20s, hundreds, 200, and so on. That made a lot of sense to me. I already knew what it was like to own a single family home, and it's a great way to get out there and get exposure to real estate. But I thought, well, look, I've got capital. I understand finance because I have been working in fintech, and I look at commercial real estate. It's really the nexus of finance and real estate. You have an opportunity to do a lot more work in terms of capital markets and with the private markets as well, with raising capital. So if that's the way your mind thinks, if you like numbers, I think that a career in commercial real estate is of particular interest. And so I was immediately drawn to it and thought, well, hey, if I'm going to go back to real estate because I decided I want to be an entrepreneur, this time we'll do it at scale.
Okay, so started out in real estate. Now you've done quite a bit over here. What made you focus on like multifamily in 2024?
Yeah, well, I would say, it's the gateway drug. It's the easiest commercial real estate to get into. Having been that I was already landlord, I understand. Everybody understands housing. Look, you either own your home or you rent. It's a basic need. And so it made sense to me to just start out there. Also, think back to the timing. My first apartment purchase was in 2020. We're still in the midst of the same housing building recession, at least. Housing prices are going up, but as far as builders are concerned, it's been difficult, right? We lost a whole generation of builders in the 2008 financial crisis. And with that meltdown, we've only recently recovered our numbers in terms of units constructed each year. We're up to about 1.5 million, roughly. That's replacement rates. So we're millions of units behind in terms of where we should be in terms of construction. That's really helped to force prices up. And I would say that was another major driver. I mean, looking at the timing, the interest rates, the number of units that we needed, it really just made a great sense to go in. There were some great tailwinds.
Wow, okay. So the fundamentals were there. So walk us through how, when you first started actively investing, there's quite a few things right here. You've done early stage companies, the car washes, the multi-units, the triple net real estate. What does 2024 look like with you? You're focused on multifamily real estate. I mean, what does that look like? Tell us a little bit more about your multifamily strategy, maybe the areas that you're focusing on and what you're looking at.
Right. A few things that I like. I like smaller deals. I like mom and pop. I like tertiary markets. These are some places where you can find stuff that's not been picked over. If you want to buy 100 or 200 unit apartments, there's a lot of competition. It's very, very difficult to buy
Yeah.
something at less than what it's worth. Now, hey, you can get very experienced. You can get in tight with brokers. You might be on the list of the first 10 that the deal goes out to. But even so, you will never find as good of a deal as when you're going out there and talking to sellers directly. A lot of times you can get a deal where there's literally no other players on the field. You can get way below market interest rates, and you can have assets that are completely under optimized. It's just a lot harder to do that in the bigger game. So for me, that made a lot of sense, especially considering that we've had so much interest rate volatility, and we don't know where it's headed next. Depending on where inflation is actually headed, we could have more rate hikes before we see some relief. So I love to see a lot of meat on the bone. And if you want to find an apartment that has rents that are $200 or $300 below market, very hard to do that unless you're willing to go and turn some rocks over in some places that are a little less studied.
Okay, so you're focusing on uh maybe like 50 units or below, stuff that a lot of that institutional capital is not going after in some of the tertiary
Absolutely. Yeah.
markets that are
20,
not as
40, 60, 80, a lot of great deals out there and a lot of great deals elsewhere too. So for me, in terms of keeping my investors safe, that's one of the very best things that I can do. The debt on those properties is it's outstanding. I mean, you don't have any covenants in most cases. You can kick everybody out, do all the renovations, raise the rent all in a year if you're willing to execute. Try doing that if you have an agency loan.
talk to us more about the covenants, because I know a lot of people listening right now probably don't know what that is. And you said a few key points there that I think a lot
Sure.
of investors pass over, which is there were no covenants on it, and there was kind of like you didn't have as many restrictions. Walk us through that.
Well, the first one is going to be your debt service coverage ratio. Okay. If you got cash on hand, you don't need to worry about that as long as you're making renovations and raising the rent. But more importantly, if you have an agency loan, they're going to require that you have at least 80% or above occupancy. That's really difficult if you're doing renovations. You get a few people moving out and you kick a few people out to do renovations, you can easily fall below that and be in some real hot water quickly.
Okay. So a little bit more leniency and flexibility
Sure, and
owning
other things
the
would be things like prepayment penalty. A lot of these loans, usually, if you have a seller financing, for whatever reason, they don't put a prepay penalty in there, and so if you're able to execute really quickly, you can there's literally no pain when it comes time to refinance.
Hmm.
And that can be very painful with agency loans or any debt, really. You might have yield maintenance where the rates go way down, and you got to pay the difference between the treasuries and where the rates are at, and that's hard. Even like a step down, like 5 4 3 2 1, 5% in the first year, 4% in the second year. That's another that's huge. I mean, if you want to get out in the second year, that could be 4%. I always insist on making sure that the step down is in our favor, like 3 2 1 1 1 and a 5 year loan. Pay a little bit more for that, because if you have the opportunity to refinance in 1 or 2 years, I don't want to have to pay tens of thousands of dollars just because I was a little bit cheap or wanted to have a little bit more cash flow up front.
Yeah. No, that makes a lot of sense. So you're focused on multifamily. You mentioned some tertiary markets. Like, what does that mean exactly? Can you name off some markets that y'all are looking at?
Sure. So, you got your major cities, you got your suburbs, and you go a little further out. That's tertiary. So, got one deal in Jefferson City. Really beautiful thing. Rents have pretty much doubled, more than doubled in some cases where we've done some renovation because we
Wow.
have a totally under optimized asset. And, again, it's really hard to find those diamonds in the rough elsewhere. But most of my stuff tends to be in the cities. I mean, that's just where most of the assets are. But I always have my eyes open.
What are some of the biggest challenges that you foresee yourself encountering in 2024 with the state of the economy and the market and the state of where commercial real estate in general is?
Well, everybody's been talking about interest rates, and I think that's distracted us from the issue of the economy. When we do have a real recession, not like the last one that lasted a few months and the government sent everybody checks, it's going to be hard. And it's going to be hard across the board, not just for Class A or Class B, but Class C particularly. Those
Yeah.
are the first people to lose their jobs.
Right.
And, you'll always have people moving down into the Class A or Class B. But the Class C is, you're going to have a lot of delinquency. There's going to be a lot of legal costs to kick out the people
Yeah.
that aren't paying. It used to be that people would say, "Oh, Class C is the safest because everybody will just come down to Class C." That's not really the way it goes. Class A, Class B, I think, are a lot safer. So you might see some reorganization in terms of assets. You might see some reorganization in terms of cap rates.
Okay. A lot to consider there. What do you think What do you think it's going to take for investors to get back into the game? It's been since we've had this interest rate rise, I'd say it's when people are working twice as hard to raise half as much money. I mean, there's a lot of capital that's just sitting on the sidelines, waiting to come back in. It seems like investors are waiting for something. What do you think is going to be that threshold or maybe that event that's going to spark the confidence to have investors, start moving back into multifamily? Because right now there's a lot of bridge debt that still hasn't come due, right? I think
Right.
$2 trillion is roughly the amount that is, has become due or is coming due. 2024 is, supposedly going to be the biggest year for it. We started to see the cracks on the wall in the fall of 2023. So, what are your thoughts there?
Well, I think that lower interest rates is going to help. Once we see people see prices going up, people are going to jump in. But at that
Yeah,
point, it's a little bit too late. As Warren Buffett put it, I mean, if you wait, you know, for the, you don't want to necessarily wait for the first swallow of spring.
yeah,
It's already here. So don't wait till spring is sprung. I think this could be a very good time to invest, but you want to have conservative debt. We don't know where interest rates are headed. I think they're headed down in the medium to long term, but what is that? Everybody said
yeah.
survive till 25. Well, we're almost to 25, and we've seen no relief in sight. So people have to be, I think, very, very careful. But if you get something that cash flows nicely now, the likelihood is that in who knows, 1 to 3 years, you could be in a much better situation.
Makes a lot of sense. What are you doing right? Let me rephrase that. Your portfolio that you started buying in 2020, I think you said you bought your first commercial multifamily property in 2020. It's been a crazy ride since then. 2020 came, there was a lot of fear.
Sure.
the market went down. People weren't sure what was happening. Then it came back with a vengeance afterwards in 2021 and 2022. I mean, crazy inflation. It was bonkers what people were selling multifamily units. And then that inflation caused the Fed to adjust interest rates, raise them. And then all of a sudden you get this bottoming that has come down. So it's been a lot of volatility. What tools have you implemented in your own portfolio to help ride that out? Because obviously you've done really well. You've ridden out what seems to be the bulk of the storm, and we're still kind of uh, horseback riding through it to get out the other end. But what did you guys do, and how did y'all adapt during that crazy volatile time from 2020 to now?
Right. Well, a lot of it is debt, right? If you got that set, you probably survive. Second thing you got to look for is margin of safety. If you can find those below market rents, then hey, even if people get kicked out, you know that just by raising rents to market, you're
Mhm.
going to be okay. You want to look at your break even ratio. What level of occupancy do you need to pay off your loan? To pay your debt service. And if you look for deals that have enough meat on the bone, you have the right debt, and you have proper reserves, then you ought to be okay.
Well, hey, that's a pretty straightforward bullet list. I like that there. Talk to us about some of these other investments, particularly the early stage startup companies. Like, how did that go? That seems to be a very risky venture. Not a lot of people are able to make that work. It's a lot of a lot of thoughts and feelings around it come from like big old billion dollar private equity companies investing in that. How were you able to have success in that stage as well?
Yeah, so I think the first rule with angel investing is you want to study out. Angel investing is fascinating because it's literally the whole world. Every product that you see on the shelves is probably came from or is influenced some way or has the potential to be influenced through disruptive technology that comes from startups.
Yeah.
So if you invest in startups, it's a lot like being an equities investor. I mean, you can study business sectors all day to look for the edge. And that's what I like about it. It's literally endless in terms of the excitement of that playing field. But you do have to bring things in a little bit. You can't be an expert at everything. So I'm not out there leading angel rounds. Okay. What I did is I went to go find my local uh, angel syndicate. And that's very helpful because they will do hundreds of hours of, of due diligence on these companies. And that's not the sort of thing that you can afford to do unless
Yeah.
you are leading a round of investment, unless you're putting in
Right.
$1 million and also benefiting from, say 2 and 20% of the capital that goes into it. That's when it makes sense to do that. But if you have something, if I've had somebody in front of me saying no 40 to 100 times for every pitch that I see, and I can look at the results of hundreds of hours of due diligence, then that's when it makes sense to invest in early stage companies. Now, most of them do fail. Some of them will somewhat break even, maybe do okay, make a small return. And then you're really just looking for that 1 or 2 out of 10 that gives you the 5, 10, 20, 50x return. So I did a couple of things. I not only decided to work with my local syndicate, but I also invested in a fund. So I'm not just out there investing in single companies. And in the fund already, we've got companies that they're already at their next round of valuation. So
Okay.
if you want to ask the question like how are things going, well, one of the best ways to do that is ask, well, your last round of valuation, where did that come in at? And so we've got some pretty decent up rounds coming in. So we know that we're doing well, and we expect some solid exits and hopefully a very strong multiple on the entire portfolio.
Oh, wow, that's fantastic. So kind of like ETF investing, it's in a portfolio of startup
Exactly.
companies
So I
rather
do
than
both, but I think it's important that if you want to just invest in single companies, you'd better be willing to invest, say 2 a year for 10 years, and then your time horizon is like 7 to 10 years.
Mhm.
So then you could be talking 17, 20 years before you're absolutely certain that you're ahead. So I would say don't do that unless you're already filthy rich. Invest in, yeah, find your local syndicate, invest in a fund, and then go ahead and invest in individual companies on the side.
Yeah, so it's interesting. There's a lot higher risk, but much higher reward. But you're mitigating those risks through diversification and
Yeah,
investing in a lot of companies that are already doing a lot of the research and investing. I'm assuming are they also investing like their own capital beside the investors, or is this just a
exactly.
pure?
Yeah. So the syndicate that leads the round, they're going to invest some money from the fund. Uh,
Mhm.
who knows? Maybe even their own private capital. These guys have a bit of dough, and then in many cases they'll also set up a special purpose vehicle, essentially an LLC, that's going to get together and take the money of individual investors and go along that. Or the other possibility is that if you're able to handle the minimums, like 50 or 100,000 or more, then you
Yeah.
can easily go more directly in. So another advantage of working with a syndicate.
Yeah, 100%. This is huge, man. So we've covered everything from doing scientific studies and with universities to doing multifamily investments to doing some angels and startups. If people want to learn more about you, George, learn more about investment opportunities, where should they go?
Yeah, absolutely. You can find me on LinkedIn. I'm there all the time. Or send me an email, George at robertscapitalenterprises.com. And if you want to learn more about real estate or housing economics, macroeconomics, etc., find me as the data scientist of real estate at YouTube.
All right, we'll make sure that those show notes get posted. And if you got value from this episode, do George and I a favor, hit the like button, share this with your friends and family, leave us a review so we can get more better content out there. George, it's been a pleasure having you on the show today.
Thank you so much, Brandon. I hope you do leave that review because it really does make a difference. I'm a podcaster myself. Thank you.